Imagine you have to choose between two apple trees. The first tree grows larger and stronger every year, but you never eat the apples. The second tree stays the exact same size forever, but it gives you a basket of fruit today. Which one do you want? When a company makes a profit, it faces a similar choice. It can either reinvest that money to grow the business, planting more seeds, or it can harvest the cash. If the company decides to take that cash and hand it directly to the people who own the stock, that payment is called a dividend. On paper, both choices build your wealth, but most of us have a powerful, deep-seated preference for the tree that hands us the fruit right now. For decades, economists argued that these payouts shouldn't actually matter. Franco Modigliani proposed that whether a company gives you cash or keeps it to grow, your total wealth stays exactly the same. Think of a company worth $100. If it pays you a $2 dividend, that money has to come from somewhere. The company is now worth $98, and you have a $2 coin in your pocket. You still have $100. Here's the strange part. When a company announces it will start paying that dividend, the stock price often climbs by 2 or 3% within days. Modigliani, pictured here, worked in a world of perfect equations where investors act like logic machines. In his math, that price jump shouldn't exist. The paradox is that investors in the real world don't follow the equations. They choose the immediate cash, even when the math says it shouldn't change their bottom line. Imagine a simulation with two identical lemonade stands. Company A reinvests profits to grow. Company B pays a cash dividend. Introducing 1,000 simulated investors, 70% swarm Company B, bidding the price up $5 to $10 for the certainty of cash today. This is Daniel Kahneman. He realized that the human brain doesn't weigh all rewards equally. Our brains see future growth as uncertain, like a tangled tree, but a dividend is a guaranteed win. Add 5% inflation, and future growth shrinks in value. Company B's immediate cash looks even safer, drawing investors faster. This suggests investors will pay a higher price specifically to avoid the anxiety of the unknown. In the 1970s, the government introduced an obstacle that should have ended the love affair with dividends, a tax system that punished cash payouts much more than company growth. Anyone thinking logically should have run away from dividends. By taking the cash, you were losing a huge chunk of your profit to taxes. When the economist John Lintner looked at what people were actually doing, he found the opposite. Even with the tax penalty, investors still preferred the companies that paid dividends. If people are willing to hand over money to the taxman just to get that payout, a dividend is clearly providing a deep sense of psychological security that goes far beyond the simple exchange of dollars. There is one more test. In our simulation, Company B's son only cuts its dividend payment in half. The investors panic. The stock price falls by 20% in a single day, even though the business makes the exact same money. Dividends act as a powerful signal. A steady payout tells the world that the people running the company are confident the money is real. Cutting that steady payout is like an alarm bell, suggesting that something is fundamentally wrong behind the scenes. A dividend is the only way a company can prove to a skeptical investor that its profits aren't just numbers on a page, but actual physical wealth. This psychological need for a sure thing still shapes how we invest today. Retirees often rely on the predictable schedule and these payments to buy groceries or pay rent without having to worry about whether the stock market is up or down that week. Many professional money managers use dividends as a filter. A company that has paid its owners for 50 years is likely a stable business, helping them avoid the hype of the next big bubble. This is why massive tech giants like Apple pay dividends. They have billions in the bank and plenty of ways to grow, but they want to attract investors who value long-term stability. Microsoft does the same thing. Even for successful companies, there comes a point where the market demands tangible proof of a cash payout. Economists once hoped that the market would run on pure, clean mathematics. But the dividend paradox reminds us that the market is made of people, and as long as humans are involved, we will always value the trust, the certainty, and the immediate reward of cash in our hands.